Good afternoon. Central Bank of Nigeria Communique number 85 of the Monetary Policy Committee meeting of Monday and Tuesday, September 17th and 18th, 2012. The Monetary Policy Committee met on September 17th and 18th, 2012 with 10 out of the 12 members in attendance. The committee reviewed the conditions and challenges that confronted the domestic economy during the first 8 months of 2012 against the backdrop of international economic and financial developments with a view to reassessing monetary policy options in the short to medium term. International economic developments. The committee noted that the global economy showed signs of further weakness in the last 3 months, with the latest data not showing any evidence of improvement up to the beginning of the third quarter of 2012. The committee also observed that the weak growth resulted from considerable financial market fragilities in the euro area, with resultant negative spillover effects to other regions, uncertainty resulting from the Eurozone crisis, as well as poor macroeconomic performance in other advanced economies. Rising food and energy prices was also a contributory factor. In July 2012, the IMF World Economic Outlook update projected that global output would moderate to 3.5% in 2012, which is 0.1% lower than the forecasts of April 2012. Growth in advanced economies was projected to decline from 1.6% in 2011 to 1.4% in 2012, with the slowdown being most severe in the peripheral economies, where the dampening effects of uncertainty from tighter financial conditions are strongest. In the US, real GDP grew at an annualized rate of 1.5% in Q2 2012, down from 0.5% from 2% in Q1. The sluggish growth was primarily due to declining aggregate consumption, government spending, and negative terms of trade. The Eurozone is on the brink of a double-dip recession following the contraction in output between April and June. Real output across the 17-nation bloc fell by 0.2% in Q2 of 2012, while signs of further contraction are on the horizon. Rising unemployment and large-scale fiscal retrenchment, coupled with increased taxes in a number of countries, constrained aggregate demand, leading to cutback in investment and low export growth. Unemployment levels across the zone have attained a record high of 11.3%, the highest since 1995, with Spain recording the highest and Austria the least. Weak financial markets and the persistent sovereign debt crisis, as well as rising energy prices, led the European Central Bank to retain its main refinancing interest rate at 0.75%. EU members remain cautious about the ECB's outright monetary transaction scheme, which is based on strict adherence to austerity measures and fiscal consolidation pact. In Asia, most economies recorded significant slowdown in economic activity up to Q2, mainly on account of weakening exports and investment. Export growth has moderated, reflecting the sluggish demand from Europe, while investment remained weak due to the heightened volatility of capital flows and the lagged effects of tighter monetary policies. China's real GDP growth slowed to 7.6% in Q2 from 8.1% in Q1, due mainly to a decline in net exports. Growth moderated in Japan, especially in Q3, due to softening in manufacturing activity. India's real GDP year-on-year moderated to 5.5% in Q2 from 6.1% in Q4 of 2011, mainly as a result of deceleration in private consumption. Overall, the growth trajectory for the remainder of the year tends towards a downturn, as downside risks including weak external demand, elevated price levels, widening twin deficits, falling investments, and rising interest rates remain heightened. Robust economic activities in the MENA and sub-Saharan Africa regions would partly offset the declining output growth in the advanced and emerging markets in 2012. Real GDP growth was projected at 5% in each of the regions, underpinned by strong natural resource prices, new natural resource exploration and production in several countries, recovery from drought in the Sahel and parts of Eastern Africa, strong post-conflict recovery in some countries, improved governance practices, and growing disposable income. Despite these developments, growth in the region faces significant downside risks on the back of increased global uncertainties. The committee believes that the recent quantitative easing measures by the European Central Bank and the US Federal Reserve System could have contributed to the high crude oil prices international market. It highlighted the possible increase in carry trade and the risk of a bubble in the domestic capital market. Domestic economic and financial developments. Output. Recent macroeconomic data indicates that the economy is performing better than forecast, although a growth in the first 2 quarters of 2012 has remained consistently below the corresponding growth rates in 2011. The provisional real GDP growth rate from the NBS stood at 6.28% in Q2, up from 6.17% in Q1, but lower than the 7.61% recorded in the corresponding period last year. The non-oil sector remained the major driver of growth, recording a 7.5% increase, in contrast to the oil sector, which contracted by 0.73% during the period. Overall GDP growth for fiscal 2012 has been revised upwards to 6.77% from the earlier projection of 6.5%. The committee welcomed the promising growth performance, although it expressed concern that the overall output growth projection is still lower than the 7.45% recorded last year. The growth drivers with the non-oil sector remained agriculture, wholesale and retail trade, and services, which contributed 1.94%, 1.69%, and 3.16% respectively. The committee noted that the relatively robust growth projections, despite the slowing global economy, reflected the continuing favorable conditions for increased agricultural production as a result of improved security and power supply. Prices. The committee observed that the inflationary pressures experienced during the first half of 2012 appeared to be moderating in the third quarter. The year-on-year headline inflation declined to 11.7% in August from 12.8% in July, while core inflation decelerated slightly to 14.7% from 15% over the same period. Also, food inflation declined sharply to 9.9% in August from 12.1% in July. The significant decline in year-on-year inflation was attributed to a decrease in inflation of both processed foods and farm produce. The committee observed that the inflationary pressures from the partial removal of petroleum subsidy in January appear to have waned in the third quarter of 2012, and that given the relatively stable exchange rate regime, the pass-through to domestic prices was low during the period. The committee, however, recognized the upside risk to inflation in the near term, to include increased spending in the fourth quarter and monetized capital flows following from QE3 in the United States. Monetary, credit, and financial markets developments. Broad money grew by 3.5% in August over the level at end December, which annualized to 5.25%. The annualized growth rate is significantly lower than the growth rate of 15.43% recorded in 2011. Aggregate domestic credit declined by 3.82% in August, annualized a decline of 5.73% from the level at end December 2011. The decline in aggregate domestic credit was due to a huge fall in credit to government, which declined by 246%. This development reflected the combined effects of the significant growth in federal government deposits with the banking system and contraction on claims to government. The introduction of a treasury single account appeared to have had the desired effect of reducing government borrowing and placing the government in the position of a net creditor to the economy. Interest rates in all segments of the money markets rose initially in response to the increase in the cash reserve requirement by 400 basis points at the MPC meeting of July 21 and 22, 2012. The rates, however, trended downwards towards the end of the review period. The interbank call and OBB rates, which opened at 17.85 and 14.99%, closed at 14.19 and 13.56% respectively under the review period. The committee expressed concerns that lending rates have remained high and enjoined the bank to sustain its efforts towards reduction in interest rate spread while stabilizing interbank rates to sustain liquidity and facilitate intermediation in the banking system. The committee noted that this can only be achieved by sustaining the current efforts at reducing overheads in the banking industry and deepening capital market reforms to diversify sources of finance for the real economy and complement bank loans. The committee observed that the recovery in the Nigerian capital market continued during the review period as equity markets indicators were positive. The all-share index increased by 9.96% between June 29th and August 31st, while market capitalization increased by 9.64% during the same period. Equity market median PE ratios at 9.86 fell below the long-run median of 10.77 by 0.91 or 8.44%, suggesting bargain valuations and an imminent rebound. The committee observed that the performance of the stock exchange during the period was consistent with global trends, especially in the wake of monetary expansion. External sector developments. At the wholesale Dutch auction system, the exchange rate during the period July 25th to August 31st opened at 157.4 naira to the dollar and closed at 157.36 naira to the dollar, an appreciation of 4 kobo. The appreciation was due to the combined effects of the increase in cash reserve requirement, the reduction in net open position, and the policy barring deposit money banks and discount houses from accessing lending windows and WDAS simultaneously. At the interbank segment, the selling rate opened at 160.05 naira to the dollar and closed at 158.15 naira to the dollar, representing an appreciation of 1 naira 90 kobo or 0.01%. The appreciation experienced in this segment was due to increased supply of foreign exchange by all companies to the interbank market. At the BDC segment of the foreign exchange market, the selling rate opened at 163 naira to the dollar and closed at 161 naira to the dollar, representing an appreciation of 2 naira or 0.01% for the period. The appreciation recorded in this segment was traced to the low demand for foreign exchange by end users vis-a-vis the high supply of foreign exchange at the interbank market and the apparent taming of speculative activities. The committee noted with satisfaction that the premium between the rates at the WDAS and the interbank and between the WDAS and the BDCs narrowed towards the end of the review period, and therefore encouraged the bank to sustain and complement existing measures to discourage speculative demand in the market. In general, the committee noted that the decisions taken at the last meeting of the MPC have produced the desired result. In the same vein, the committee expressed satisfaction with the significant accretion to external reserves during the period. Gross external reserves as of September 5th, 2012 stood at $41.81 billion, representing an increase of $6.4 billion or 18.07% above the level of $35.41 billion at end of June 2012. External reserves increased by $8.88 billion or 27% on a year-on-year basis, compared with $32.93 billion at end August 2011. The increase in the reserve level was driven mainly by proceeds from crude oil and gas sales and crude-related taxes. The foreign reserves level could finance over 7 months of imports. The committee's considerations. Given developments in the global and domestic economy and the financial markets, the committee noted that the weak global growth indices called for cautious optimism by policymakers. The resolution of the euro area debt crisis remains a major concern, even with the approval of the efforts of the ECB to address the debt crisis in the euro area by the German Constitutional Court. It further noted that its decision at the July MPC meeting appeared to have had some positive impact in a number of areas, namely a deceleration in year-on-year inflation in August 2012, stability of short-term interest rates around the MPR, build-up in external reserves, and stability in the exchange rate. However, core inflation is still high at 14.7% in August. The threat of increased inflow of hot money arising from actions of the US Fed to further stimulate the economy through its QE3 activities and its capital reversal implications were also noted. The committee noted the rise in oil prices, but cautioned against a hasty deployment of the windfall to immediate consumption, as the trend could be reversed. Monetary policy could not, therefore, under the circumstance, react to what may be purely temporary phenomena. Despite the threats from a combination of global and domestic factors, the committee noted that the level of economic growth in the third quarter remained robust, and the year-end forecast would likely be met, owing largely to improvements in power supply and the steady progress of reforms, actions in respect of the alleged fraud in the petroleum subsidy regime, and improved fiscal operations. The committee noted that these measures generally take time to impact the real economy. With this development, the committee observed that the inflation outcome for the remaining period of the year is likely to be lower than the initial forecast. The committee would continue to monitor developments in the price level and remain firm in its commitment to price stability as its mandate. The committee also noted that the growth rate of real output, though impressive by global trends, was on a downward trend since Q1 2010, most especially in the agricultural sector. It was of concern to the committee that the declining output in the agricultural sector was traceable to the security challenges and high intensity of rainfall, which has led to flooding in several parts of the country. It noted that the measures taken at the last MPC meeting have succeeded in stabilizing the foreign exchange market, as well as enhancing the build-up in external reserves. Overall, the MPC believes that the current rise in crude prices and tight monetary policy regime presented an opportunity for building reserve buffers in light of uncertainty surrounding the global economy. The committee therefore identified the key policy challenges to include: 1. Protecting the domestic economy and building external reserves buffer. 2. Potential large inflows of hot money resulting from further monetary easing in the US and Europe and improved yield on fixed income instruments. And 3. Persisting high core inflation rates. The committee noted that this moderation headline inflation has not been accompanied by a significant decline in core inflation. Given the unpredictability of food prices, there is a need to watch this trend as we approach year-end before altering the present monetary stance. Decision. In view of the foregoing, the committee, by a unanimous vote, decided as follows: 1. Retain the monetary policy rate at 12%, plus or minus 2%. 2. Retain the cash reserve requirement at 12%. And 3. Retain the net open position at 1%. Thank you.
Questions, please identify yourself and the institution you represent.
To know your thoughts on the outlook for the Naira over the rest of the year. And secondly, considering the growth in foreign portfolio investment into Nigeria's bond markets and the potential for these investors to divest in the economy, is it more important today for the central bank to keep the Naira stable? And then lastly, how much is being invested in Nigeria's bond market by foreign portfolio investors since the July MPC meeting? Thank you.
Do you have the number? What's that table?
You can give her the number.
Just one? Okay. All right. The outlook, obviously, for the Naira is stable. We think that oil prices will hold firm for a while. The QE measures in the United States and the decision of the ECB to purchase sovereign bonds, even though that is subject to fiscal compact, suggests to us that there will be continuation in carry trade. The uncertainties in the Middle East, the whole issues around Iran and Syria will continue to exert pressure on that market. So we don't think oil prices, I mean, we keep our fingers crossed, obviously, and our job is to ask what happens if there's a crash. But on the balance of risks, we think in the short term, oil prices will be firm. We plan to keep monetary conditions very tight, which means that we do not see much of a risk of a very quick reversal of capital flows unless there is a major disaster in Europe and the United States. And the most important thing is to keep a tab on how much money comes in. I think in August, if I remember, we saw the table today, we had about $3 billion in the month of August, which was twice what had been coming in July and June, the average. And it reflects a more accommodative monetary stance taken by the US and Europe. It also reflects the high yields that are available here and the relative stability in terms of macroeconomic indicators. Thank you. No, there are questions about.
Please identify yourself.
Good afternoon. My name is Sarah Okila. I come from Channels Television. The House of Reps just called for the suspension of the introduction of the 5,000 naira notes. Would like to have the CBN governor's take on that. Your reaction, sir?
I have heard it. I have no reaction. Okay, I've just been corrected that the figure is 1.4 billion, not 3. Okay, thank you.
That was a fantastic reaction, Doctor.